Hey everyone, it is Evan here from the Trade Risk on Tuesday, February 25th, here with a midweek market recap video. We're going to cover all of the major markets and the current market environment. So congratulations if you're watching this video, you survived the 2-day pullback here. It has been extreme, it has been quick, and it has been powerful. If we take a look here at the numbers for the major indices, you can see it was another deep red session today with all of the major indices falling about 3% on the day, and that follows about a 3% down session yesterday to kick off the week. So if we look here at these 5-day change numbers, some of the worst that we've seen in for a 5-day change basis, some of the worst we've seen in certainly months, perhaps even years, to see 7-8% down moves over the past several trading sessions. If we take a look at how the major indices are now faring against some of those key simple moving averages, well, they're certainly losing the majority of them. We're below the 10, we're below the 50, and we're starting to lose even the 200 SMA across the major indices. Now, if we scroll down and take a look at sectors here, it's of course a sea of red. On the upside, we basically have staples, utilities, and biotech, which is interesting, still holding up there in the top 3. But, keep a look at those percentages. They're still minus 4% over the past 5 days. So they're certainly not doing you too much good, even if you own those sectors outright. And on the downside, we have semiconductors, we have tech, and we have energy down almost 10% over the past 5 trading sessions. Now, in terms of major markets, we basically have this destroying my scale here because the VIX is up almost 100% over the past 5 trading sessions, so it kind of dwarfs everything else in here. But that is obviously the beneficiary here, followed by TLT and gold. And on the downside, we have SPY, emerging markets, and natural gas in the bottom 3. Surprised China's not down there, and maybe even high yield and some of those others, but got natural gas down there in the bottom 3. So let's take a look here at the charts. Let's try and make sense of what's going on, where we are, and certainly kind of where we stand in the bigger picture. So this is a weekly perspective here of the S&P 500. We always like to start with a weekly chart just to get our sense of what's going on in the bigger picture. And we can see here that this is certainly a follow-through week to the downside, a gap down week, and so far just a total drop with no real bid that has surfaced yet in sight. It is of course only Tuesday, so there's still 3 trading sessions left in this week, so we'll see how this market fares come Friday. But as it stands right now, it's going to go down as one of the biggest down weeks we've seen in quite some time. We're down 6.19% so far in 2 trading sessions, and I have this number here because this is the pullback, the approximate pullback. I don't know if I have the exact percentage, but this is more or less where we traded at the lows off of the all-time highs. So as it stands right now, the S&P 500 in pretty much 2 to 3 trading sessions has fallen about 8% off of the highs made just 2 weeks ago. And when we zoom out here, we just take a look at the bigger picture perspective here of the S&P 500. You can see, of course, this up channel here that we started to basically break. I mean, the break certainly happened this week. We started to break down, though, about 4 weeks ago, right in here. We quickly recovered back into this channel. Again, it's not drawn so precise, so I don't want to get too hung up on whether or not this was up or below it. But I think, as we think about this potential kind of break here, we recovered, we kind of got back on trend, and then this week here, so with last week, we had kind of the outside reversal, little bit of a pullback here into this 3,300 level. We talked about that being a significant spot for this market to hold. It, of course, didn't hold it. It dropped to the bottom of this range, and now here we are, basically crashing lower, to use a very charging word there, but we are essentially in free fall here, kind of breaking down and retracing this bigger trend and channel that we've been in since early October. So real quick though, when we kind of just look here at the magnitude of this move. So really, if I draw from basically October all the way up to the recent highs here, and I throw some fibs on, we've basically at this point retraced 50% of this rally that started in October. You could certainly use the summertime rally, which would be, basically about a 40%, 45% retrace. Either way, the good times that we've had over the past, call it 6 months or so, has basically been 50% of that has basically been wiped out at this point. So when we look here, if we go to our other view with a much more busy view here of some prior horizontal levels, and we kind of zoom out into the big picture, you can see us kind of falling back into the abyss of some of these old horizontal levels that we were paying attention to as this rally progressed. But as we come back down into this 31.25, there's still lots of layers in here, lots of shorter term layers that the market had previously cared about. I think 3100, this is a pretty important area in here as well. Let me just try and clean it up for everyone. Right around 3100, you can see just all of this supply in here for about, I guess, a full month or so throughout the course of November, early December, where the market mostly traded kind of in this sideways move here, had a couple of attempts and support getting built around 3100. So that's certainly a significant area, and it's very, close underneath us at this point. In fact, it's only about 1% below us at this point. So if we do see some more pressure tomorrow, we could be back to those levels. And then, of course, if you want to go even further than that, we can start looking at back to the weekly chart, and we start looking at the actual breakout here, which was around 30.29 that occurred in November of this year. So if you recall, the market went sideways here for a number of months. It topped out in the summertime, it pulled back, it got back up to it in fall time, and then it pulled back once again, and then it ended up breaking out in November of 2019. So if we get all the way back to that breakout level, that's about 30.30 here in the S&P 500 cash market, and that's approximately another 3% below where we're currently trading. So if the market opens up tomorrow and does exactly what it did today, and it closes down 3%, we'll be back here. We would have retraced about 70% of the October rally, and we'd be back to a very significant multi-month kind of breakout retest, if you will, if that occurs tomorrow. So those are some levels to think about. And if we think about sort of where we are just again in this bigger picture and what we should be thinking about as traders, we know that the S&P is around 7.94%, so almost an 8% retracement. If we look at the IWM, this is about 8.5% now off of not the all-time highs, but the recent highs made earlier this year. And if we look at the NASDAQ 100, we're almost 10%, we're 9.5% off of the highs made just 4 trading sessions ago. So when we think about those levels, the one thing I want to just reiterate here is that I know a lot of traders that I talk to, and sometimes they write in, they ask, when is the pullback going to happen? Of course, nobody can answer that, but when's the pullback going to happen? I want to invest on a pullback. We're not getting a pullback. This is a pullback, and this is about a 7, 8, 9, 10% pullback in some of these major indices. So if you had a plan to invest in a pullback, this is not a recommendation by any stretch. You have to follow your own plan and strategy. But if you're someone that's been waiting for a pullback, then this is the opportunity. This is a pullback kind of looking us right in the face. The question is, do you think this market has more to go? Is this, too scary of a spot to invest? These are the things that might be holding you back from investing on a pullback at this point. But if that was your plan, if you were looking for a pullback, then again, you certainly have it. Now, one other thing I want to sort of bring up here, and this is certainly a cherry-picked example, but I think it still is pretty interesting here from just a statistical standpoint. But again, I'm going to sort of debunk it at the end. If I look here at this indicator at the bottom of my charts here, so this is just a simple rate of change indicator, and it's looking back over 2 trading sessions. So basically today's action and yesterday's action. And I zoom out here and I take a look at what the rate of change has been over the past 2 trading sessions, going back multiple years. In fact, if I go back as far as TC2000 will let me on a daily chart, you can basically see that we have the top three. So there's only been 2 times in the past 5 years that we've seen a more significant 2-day sell-off than we are right now. The last one was in January of 2018, which I think is probably still fresh in a lot of people's minds. And then if we go all the way back to 2015, when we had that very sudden sort of summertime flash crash slash meltdown back in 2015, that was the last time we saw a rate of change, a loss basically this big in just 2 trading sessions. So that is pretty significant. You can go across all of the major indices here and you'll basically see the same thing. If we look at the Russell 2000, you can see just from this oscillator standpoint, when we look at this rate of change indicator, you can see just how extreme this reading is down here from a percentage basis. And last but not least, if you look at the NASDAQ 100, again, you can see going back 5 years, this happens to be, pretty much the second worst or most extreme reading that we've seen over 5 years. So it's basically just another way to visualize the significance of kind of the sell-off that we've seen over the past 2 trading sessions. I said I was going to debunk this at the beginning, and just the reason why you have to be a little careful here is because you can easily cherry pick these stats, right? So I could make for a good headline right there writing about the 2-day change number being at 5-year extremes. But, if we start to look at a 3-day period, a 4-day period, a 5-day period, and we start just climbing up here, then it is in less extreme territory if we start looking back over, 14 days of rolling returns or 20 days of rolling returns. Doesn't mean it's not significant. You just have to understand sort of the context of the stat. It does still basically depict that the last 2 days of selling has been extreme. Whether or not that is meaningful for you, you will have to decide, but it's certainly an interesting way to view this action here. And I would basically just add one last comment on the last 2 days of action, is that I don't think that this is very orderly action really whatsoever. I see a lot of comments saying that the sell-off looks pretty orderly at this point. When I look here at this chart, this does not look orderly to me. This looks like an extreme kind of rush to the exit door. Whether or not it leads to more action or this is the bottom, I don't know. I think that's a different question, but I wouldn't say that this is necessarily orderly selling. This looks like get me out, as quickly as possible. So that's really where we stand for the markets here. Lots of damage here in the short term. We're very much stretched in the short term. We're about 8 to 10% off of highs, and we have some levels to look at heading into the end of the week. So at this point, risk management obviously is important. Following your strategy is important. So whatever makes sense for you, whether that's going to cash and riding out the storm, or if it's buying into this dip to look for some opportunities. I know the strategy that we trade, the Merlin strategy, has been buying on these past 2 days, or today, not really yesterday, but today, it was buying and it was looking to accumulate some exposure here. That may or may not be right for you, but in our strategy, that's what it's going for, and that's what we like to follow. So, make sure you're, again, following the plan, managing risk, and not getting too headline crazy, looking at percentages and headlines and the fear that is sort of out there. So with that, I think we covered pretty good in depth there of some of the psychology of the market and some of the technical levels. Hopefully that was helpful. If we look at some of the other markets now, we go to TLT. And we look here at this move. I mean, this here is sort of the poster, kind of flight to safety asset here. So as things melt down in equity land, we tend to go to bond funds, and we could look at just BND, or we could look at the AGG, and right down the list, all of the bond funds, whether across the spectrum or on the long end of the curve, basically has been, driving to the upside and in a strong trend. That makes sense. That breakout started early. If you recall, about a week ago, we saw bonds really starting to get aggressive and start trading at nearby highs, and that, of course, was sort of the precursor to some of the equity meltdown there. So TLT bonds in general, very stretched, but holding up and performing, particularly when equities are getting hammered. If we look at gold, I think gold is, so gold yesterday got really frothy here up at the open, opened around 158 or so. And if we zoom out, you're getting much closer to a lot of that overhead supply back from the 2011, 2012, 2013 trading days. But it got as high as about 158, and then we saw basically most of selling pressure throughout the day, and then it followed through lower today. So looks a little tired here in the short term. It certainly came back down and kind of pulled back into this gap. Maybe it's getting back to this more aggressive shorter term trend line here, so maybe there's some short-term interest around this area, but for now, it looks a little bit tired. And I think silver is actually even more actually disappointing, because silver was really starting to break some key levels, was starting to finally come alive, and with the 4% move it saw today kind of slamming back down into effectively last week's lows. And as it stands right now, if it closed where it does or any lower, it's going to have a bearish engulfing bar here on a weekly chart. That's pretty disappointing here, I think, for the silver bulls that were looking for this breakout to get going. I know we were excited about this week one breakout. Didn't buy it, don't have any positions on it, but it was exciting to see the week one there, but it's not really getting that immediate follow through. So metals, certainly not faring as bad as equities, but a little disappointing here in the past two trading sessions. And then if we look at energy, so we go to oil next, you can see is back to these lows, back to the making new lows here, and potentially losing a very significant level. We're going to be in trouble here for oil if it starts really, accelerating lower and starts leaving behind this $10.40-50 area, because we really haven't been down there since 2018. We had that of course the big sort of meltdown here in 2018 into the end of the year, and it ended up stabilizing all the way down around $9.30. So if we do head back down there, you're talking another 10-11% before some more relevant price structure. So oil is trading at a dangerous spot, and natural gas hasn't quite broken down to new lows yet. It's just back into this old range. This, of course, is kind of in a different pattern here, which is basically downtrends on all time frames. This here hasn't broken to new lows, but certainly doesn't have a whole lot to hang its hat on. It needs to get back above $15, 15 and a quarter. If it can start doing that, it can start shaping up and start acting well. But until and if that happens, got to be careful here in natural gas. So that's it. That is the midweek recap there. Lots going on. It was a very quick move to the downside, and if it caught you by surprise, take some time off, square away positions as necessary, and then of course you want to just do your homework to make sure you don't repeat those same mistakes in a future time. So make sure your risk management principles are sound, and this is a good stress test for them in this type of environment. So that's it for me. Thanks as always for tuning in and watching. Every Tuesday and Friday we do market recap videos just like this. You can subscribe on our YouTube channel or follow us at The Trade Risk. Have a great rest of your day, and we'll see you back here tomorrow for some trade ideas during the market session.